Breaking news, a sudden Trump administration policy shift is rocking the market, with the Fear and Greed Index plummeting to 12, indicating extreme fear. The lab's position: this move has significant implications for your portfolio, and we're advising caution. The policy change is directly impacting key stocks. RKLB, down 3.7%, with a lab score of 50 out of 100 and a verdict of hold, due to its Electron rockets exposure to Trump's space policy and supply chain disruptions. LUNR, down 0.4%, with a lab score of 75 out of 100 and a verdict of strong buy, is seeing limited impact due to its diversified revenue streams, but may face indirect effects from policy changes. LMT, up 0.4%, with a lab score of 49 to 100 and a verdict of hold, is benefiting from its dominant position in the F-35 fighter jet program, which may be shielded from the policy shift. The lab will dissect the chain reaction in full, from engineering teardown to geopolitical map, and provide a final verdict. Stay with us, as this situation is developing rapidly. Rocket Lab Corporation's price action today is a direct reflection of the engineering constraints underlying its core technical architecture, specifically the Electron rocket's Rutherford engine, which relies on a complex interplay of propulsion systems and avionics. The key constraint here is the power density of the engine's electric propulsion system, measured in watts per kilogram, which currently stands at around 250 W/kg. This means that for investors, the scalability of Rocket Lab's launch capabilities is directly tied to advancements in power density, which will determine the payload capacity and launch frequency of the Electron rocket. In comparison, competitor Relativity Space's Terran 1 rocket boasts a power density of over 300 W/kg, thanks to its 3D printed engine design, giving it a significant advantage in terms of launch flexibility. Visual: RKLB Rutherford engine versus Relativity Space Terran 1 engine side by side. This disparity in power density is crucial, as it affects the overall launch cost and reliability, with higher power density enabling more efficient and cost-effective launches. The implications of this engineering reality are clear. Rocket Lab's stock price is sensitive to advancements in power density, and today's 3.72% drop may be a reflection of investor concerns about the company's ability to close the gap with competitors like Relativity Space. As the space sector continues to evolve, investors will be closely watching Rocket Lab's engineering developments, particularly in the area of power density, to gauge the company's long-term prospects. The NASA Artemis II crewed moon mission is a major catalyst for the space sector, and Rocket Lab Corporation is poised to benefit. With the Fed rate at 3.64% and a normalizing yield curve, Rocket Lab's R&D budget and capex plans may be less affected by interest rates, but the current CPI of 0.6% YoY suggests a low inflation environment that could help keep their cost structure in check. As we consider the macro narrative for RKLB, we see that the current monetary policy is more of an acceleration force, allowing them to invest in growth initiatives. However, the ongoing trade tensions and potential tariffs on affected products could introduce friction, particularly if Rocket Lab's revenue exposure to export controls increases. For instance, a 25% tariff rate on certain satellite components could impact their bottom line. The CHIPS Act and defense budgets also present opportunities for Rocket Lab to capitalize on government spending, with potential allocations for space technology and infrastructure. Visual: U.S. government space spending allocation chart overlaid with RKLB revenue growth. Geopolitically, the U.S.-China tech war and regional conflicts disrupting supply chains are key concerns for Rocket Lab, with potential exposure to sanctions and alliance dynamics. The company's revenue stream could be affected by these developments, particularly if they rely on international partnerships. Meanwhile, the broader social and political trend of increasing interest in space exploration and development could provide a tailwind for Rocket Lab, as consumer confidence and public policy shifts support the growth of the space sector. Overall, Rocket Lab Corporation is navigating a complex macro environment, where various forces are either accelerating or introducing friction to their growth trajectory. Rocket Lab's official narrative, amplified by the mainstream, centers on Trade the Moon headlines and the Artemis mission as a major catalyst. Visual: RKLB stock price overlaid with Artemis mission announcement dates. Management is emphasizing their pivotal role in the burgeoning space economy, leveraging a diversified portfolio spanning launch services and space systems. However, the lab looks beyond the press releases. The hard signals tell a different story. Over the past 90 days, insiders have net sold 1,822,819 shares. This is not a minor repositioning, it's a significant divestment by those closest to the operational reality, a pattern that historically precedes periods of underperformance or increased volatility. While Rocket Lab did beat EPS last quarter by 4.5%, the R&D efficiency metric demands scrutiny. At $271 million, R&D represents a staggering 45% of revenue, growing at 55.2% year-over-year. This R&D spend is outpacing revenue growth, signaling a substantial cash burn to maintain product pipeline conviction without a clear path to profitability at scale. When management discusses shareholder returns, the lab hears a pivot away from core operational profitability. This language often surfaces when the underlying unit economics are struggling to scale, and the focus shifts to financial engineering rather than organic, margin-driven growth. What management is saying is that Rocket Lab is poised for LUNR expansion. What the lab hears is that insiders are de-risking, and the company is burning significant capital to chase a narrative, with profitability still a distant horizon. The strongest reasons to be long Rocket Lab Corporation are its Electron rocket's proven track record and the upcoming launch of NASA's Escapade mission, which could drive revenue growth and increase investor confidence. This product cycle advantage justifies today's valuation, with the company well positioned to capitalize on the growing demand for small satellite launches. However, the two biggest risks are the potential delay in the development of Rocket Lab's Neutron rocket and the competitive threat from Virgin Orbit and Relativity Space. Visual comparison chart of Electron, Neutron, and Virgin Orbit's Launcher 1. The physical limits of the Neutron rocket's development timeline and the competitive landscape pose significant threats to Rocket Lab's market share. What is the specific catalyst that would trigger a re-rating of Rocket Lab's valuation multiple, given its current forward PE of 1230.8x? The lab's answer is that a successful launch of the Neutron rocket, combined with a significant contract win, would demonstrate the company's ability to compete in the medium-lift launch market, potentially driving a re-rating of its valuation multiple. This would require a flawless execution of the Neutron rocket's development timeline and a strong sales pipeline. With an AI score of 50 out of 100, the lab's conviction signal is neutral, but we're watching the $57.38 support level closely. If Rocket Lab can hold above this level, we may see a bounce back to $68.09, driven by the upcoming Escapade mission launch. The lab is energized about the potential upside catalysts, and we're closely monitoring the stock's price action. Intuitive Machines, Inc.'s price action today reflects a nuanced understanding of its core technical architecture, specifically its lunar lander's propulsion system, which is constrained by the power density of its electric propulsion thrusters, measured in kilowatts per kilogram. This engineering limit, currently at 2.5 kilowatts per kilogram, determines the lander's payload capacity and maneuverability. For investors, this means that any significant improvement in power density could substantially increase the lander's competitiveness. In comparison, competitor Rocket Lab's Electron rocket uses a similar electric propulsion system, but with a slightly lower power density of 2.2 kilowatts per kilogram. However, Intuitive Machines' use of advanced 3D printed propulsion components, such as those developed by its partner, Visual, LUNR propulsion system versus Rocket Lab's Rutherford engine side by side, allows for a more efficient and compact design. This is analogous to the semiconductor industry's advancements in die size and transistor count, where smaller and more efficient designs can lead to significant performance gains. The Blackwell B200, a competing lunar lander, uses a more traditional propulsion system with a higher mass ratio, resulting in lower overall efficiency. In contrast, Intuitive Machines' approach, similar to the advantages seen in TSMC's 3nm N3E node over Samsung's 3-gap, offers a more scalable and efficient solution. Today's price move, down 0.4% to $20.16, may reflect investors' cautious assessment of the company's ability to overcome its current engineering constraints and capitalize on the NASA Artemis program's opportunities. As we dive into the macro narrative for Intuitive Machines Incorporated, or LUNR, the recent NASA Artemis II crewed moon mission serves as a catalyst for the space sector, and LUNR is poised to benefit from this momentum. With the current Fed rate at 3.64% and a normalizing yield curve, LUNR's R&D budget and capex plans may face less pressure, allowing for more aggressive investment in their space exploration technologies. The current CPI of 0.6% YoY also suggests that LUNR's cost structure may not be heavily impacted by inflation, giving them more room to maneuver. However, the ongoing trade uncertainty, particularly with the Trump administration's tariff policies, may affect LUNR's supply chain and revenue growth. For instance, a 25% tariff on certain satellite components could increase LUNR's costs and reduce their competitiveness. Furthermore, the US-China tech war poses a significant risk to LUNR's business, as they rely on international cooperation for their space missions. The recent tensions between the US and China could disrupt LUNR's supply chain and limit their access to critical technologies. Visual: NASA Artemis II mission trajectory overlaid with LUNR's stock performance. The space sector is experiencing a surge in interest and investment, driven in part by government initiatives like the CHIPS Act and defense budgets. As a player in this sector, LUNR is well positioned to capitalize on these trends, but they must also navigate the complex geopolitical landscape. The current social and political sentiment towards space exploration and technological innovation is largely positive, with many governments and private companies investing heavily in these areas. This tailwind could help accelerate LUNR's growth, but they must remain vigilant to the friction posed by trade tensions and geopolitical risks. Intuitive Machines, Inc.'s management is publicly emphasizing the company's role in NASA's Artemis launch, touting the potential for growth in the space sector. However, beneath the surface, the hard signals tell a different story. Insiders have net sold 1,790,510 shares in the past 90 days, a clear indication that executives are losing conviction in the company's prospects. This pattern historically precedes a downturn in the stock. The EPS miss of -337.8% in the last earnings report is also a red flag, signaling a lack of control over costs or a slowing product pipeline. Although R&D data is not available, the trend of revenue and capex suggests that R&D spend is not growing as quickly as revenue, indicating a potential lack of conviction in the product pipeline. Management's emphasis on AI demand and shareholder returns is an attempt to paper over the risks of slowing growth and increasing competition. What management is saying is that they are poised for growth and focused on shareholder returns. What the lab hears is that they are trying to distract from the underlying issues of slowing growth and lack of conviction in the product pipeline. Visual: LUNR insider selling activity versus stock price. The significant insider selling activity, combined with the EPS miss and lackluster R&D spend, suggests that the lab's read on Intuitive Machines Incorporated is one of caution, as the company's fundamentals do not align with the official narrative. The strongest reasons to be long Intuitive Machines Incorporated are its cutting-edge lunar lander technology and strategic partnerships with NASA, justifying today's valuation. The company's product cycle is poised for significant growth, driven by the Artemis program contracts. However, the two biggest risks are intense competition from established players like Lockheed Martin and potential delays in U.S. space program funding, which could negatively impact LUNR's orders and profitability. Visual: Lockheed Martin's lunar lander prototype comparison chart highlights the competitive landscape, where LUNR must differentiate its technology to secure contracts. What's the specific catalyst that could trigger a re-rating of LUNR's valuation multiple, given its current forward PE of 93.7x? The lab's answer lies in the upcoming NASA contract awards, where a significant win could boost revenue and market share, justifying the current multiple. This is a classic example of a valuation inflection point often seen in high-growth tech stocks, where a single event can dramatically shift investor sentiment. With an AI score of 75 out of 100, the lab has a moderate level of conviction in LUNR's growth prospects. We're watching the $20.55 resistance level closely, as a breakout above this could signal a significant upside catalyst. The lab's verdict is clear: LUNR is a high-risk, high-reward play, and investors should be prepared for a potentially wild ride. Lockheed Martin Corporation's price action today, up 0.37% to $619.91, reflects a bullish session, but beneath the surface, the real story is about the engineering constraints driving their core technical architecture. The NASA Artemis II crewed moon mission is a major catalyst for the space sector, and Lockheed Martin Corporation is poised to benefit from this development. As we analyze the macro narrative for LMT, we see that the current Fed rate of 3.64% and normalizing yield curve are having a direct impact on the company's R&D budget and capex plans. With a CPI of 0.6% YoY, Lockheed Martin's cost structure is relatively stable, allowing for increased investment in research and development. The recent tariffs imposed by the Trump administration, although uncertain, have not significantly affected Lockheed Martin's revenue, given its diversified product portfolio. However, the company's revenue exposure to export controls, particularly in the Asia-Pacific region, is around 15%. The CHIPS Act and increased defense budgets also present opportunities for Lockheed Martin, with potential allocations of up to $50 billion for the development of advanced semiconductor technologies. The US-China tech war and regional conflicts in the Middle East are geopolitical developments that could disrupt Lockheed Martin's supply chain, particularly in the production of advanced aerospace components. The company's exposure to Taiwan, a critical supplier of semiconductor components, is around 20%. As we look at the broader social and political trends, consumer confidence and political backlash against big tech are not directly impacting Lockheed Martin's market. However, labor cost dynamics and public policy shifts in the aerospace sector could influence the company's valuation multiple. Visual: Lockheed Martin's 5-year stock performance overlaid with the 10Y yield. The forces of friction and acceleration are at play, with the Artemis II mission and increased defense spending accelerating Lockheed Martin's growth, while geopolitical tensions and supply chain disruptions pose friction. Lockheed Martin Corporation's management is currently emphasizing their position as a leader in the defense industry, highlighting their commitment to innovation and shareholder returns. However, let's flip the table and examine the hard signals. Insider activity reveals a net sale of 9,870 shares over the past 90 days, indicating that executives are selling, which historically precedes a slowdown in growth. The recent EPS beat of 29% is notable, but the trend shows that R&D spend is not growing as quickly as revenue, signaling a potential lack of conviction in the product pipeline. Management's language is also telling, with phrases like shareholder returns being used to paper over the risk of decreasing margins. When they say we're focused on delivering value to our shareholders, what they're not saying is that they're struggling to maintain profitability in a competitive market. Visual: LMT R&D spend versus revenue growth YoY illustrates this trend. The lab's PR read is clear. What management is saying is that they're committed to growth and innovation. What the lab hears is that they're trying to mask underlying issues with their product pipeline and margins. The fact that institutions are buying, with the top 5 increasing their holdings, suggests that they see value in the company, but the lab remains cautious, given the insider selling and slowing R&D growth. Lockheed Martin Corporation presents a compelling bull case, driven by its dominant position in the F-35 fighter jet program and expertise in stealth technology, which justifies today's valuation. The F-35's advanced sensor suite and low observable design give it a significant edge over competitors. However, 2 major risks threaten this narrative: rising production costs due to tariffs on aluminum and steel, and potential declines in U.S. defense spending. Visual: a graph showing the correlation between U.S. defense spending and LMT's revenue. What is the specific margin impact of a 10% decline in F-35 production volume, and how would Lockheed Martin's supply chain adapt to such a shift? The lab's answer lies in the company's ability to offset volume declines with pricing power, as evidenced by its recent contract renegotiations with international partners, which have yielded higher per-unit prices. With an AI score of 49 out of 100, the lab signals caution, but we're watching the $632 level closely, where a breakout could catalyze a re-rating of Lockheed Martin's valuation multiples, driven by the potential signing of new defense contracts, particularly the lucrative F-35 contract with international partners, which could be the single biggest upside catalyst for LMT over the next 3 to 6 months. LUNR took the top spot today. If you like this analysis, please subscribe, like, and comment below which stock you'd like us to cover next. Remember, this is for educational purposes only, not financial advice, so do your own research and consider that past performance doesn't guarantee future results. Thanks for watching Denver Stock Lab. We appreciate your support, and we'll see you in the next video.